Welcome back to the Retire As You Desire show. Now, did you know that your Social Security could be taxed? Some people watching this, as our producers here at the TV studio are shaking their heads, they did not know that. A lot of people in the United States do not know that your Social Security could be taxed. And you're thinking to yourself, why is this possible? How is this possible? I've paid into this for 30 or 40 years of my life, and now I'm learning, going into retirement, that I'm going to be taxed on my contributions. It's kind of mind-boggling, right? In today's show, we're going to go into how your Social Security is taxed, why it's taxed, and what causes it to be taxed. So stick with us for the whole entire show, because this is something that I've seen a lot of retirees go into retirement not estimating for, and it creates a tax bill that you kind of get shocked at the end of your first retirement year saying, how is this possible? So for today's show, Social Security is really a beautiful thing if you think about it. It's almost like a forced savings. Some of the downfalls are if you unfortunately pass away early in retirement, you don't get your full benefit, but maybe your spouse will. Maybe they'll get the benefit if you are the higher wage earner throughout your working years. That happened with my mom and my dad. When my mom passed away, my dad was able to have a higher benefit because of my mom. She was the higher earner. She was incredible. So it depends on your situation. But going into how your Social Security could be taxed is a whole nother conversation in and of itself. And your financial advisor, if they're doing their job, they should be talking to you about this. And this is what we do when we take people through the Retire As You Desire plan. We talk about these things. So from a Social Security standpoint, how is it taxed? What makes it taxed? Let's start getting into some scenarios and some detailed opportunities to learn how things work. So you're probably thinking, I already know Social Security is taxed, or I had no clue. That you're one or the other. So let's get into how your Social Security is taxed in our first segment today. Your Social Security benefits may be taxed and it may be subject to federal income tax depending on your combined income and your filing status. Whether you're single or married, all of these things are going to have an impact on your Social Security income taxation. But let me give you a detailed explanation as to how the Social Security benefits are taxed. This is an important one, so get your pen and paper out, take some notes here. You're going to want to save this for later. Now, determining your combined income. This is important. To determine if your Social Security benefits are taxable, you first need to calculate your combined income, which is the sum of your adjusted gross income. A lot of people reference this as AGI. This is your income from all sources in retirement, excluding your Social Security benefits. And this gets adjusted for specific deductions. Now, there's also non-taxable interest in retirement. This is interest income that is not subject to federal income tax, such as income from municipal bonds. So if you've been a high earner, you have municipal bonds, you're not federally taxed on this. But half of your Social Security benefits, 50%, you could be taxed on a certain amount of this. So this is part of your AGI, which is 50%. So income is equal to AGI plus non-taxable interest and your Social Security benefits divided by 2, basically. It's 50% of that. And that's going to give you a tax threshold. Now, this is very, very important to know. You're probably thinking, this is a formula that I've never heard of. My accountant didn't tell me this, or my advisor didn't tell me this. Listen, it's okay. You're here learning this with us now. We could plan for things in the future for you as well. But understanding this right now could be a huge benefit for for your retirement income years. Now, these tax thresholds, let's talk about this. The portion of your Social Security benefits that is taxed is going to depend on your combined income and filing status. If you're single, a head of household, or a qualified widower, all these things play an effect. They have a different role. So if your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefits may be taxable. Yes, 50%. If your combined income is any more than $34,000, up to 85% of your benefits may be taxable. It's unbelievable, right? It's really devastating for some people if you don't know this. Married filing jointly. This is different. If your income is between $32,000 and $44,000, up to 50% of your benefits may be taxable. Yes, 50%. Now, if your income is over $44,000, up to 85% of your benefits may be taxable. Now, this is devastating for some people. They don't realize that up to 85% of your benefits could be taxed. Really important to know this going into retirement. It's better to plan for this before rather than dealing with it afterwards. Could be devastating. But if you're married, filing separately, if you live apart from your spouse for the entire year, the same thresholds are going to apply as a single filer, and it's more devastating than being together. So if you live with your spouse at any point in the year, up to 85% of your benefits could be taxable, regardless of your combined income. Now, if you don't live with your spouse throughout the year, up to 85% of your benefits could be taxable. That could be a big, big blow to your retirement income and your taxes. Now, calculating taxable benefits is very important. Once you determine the percentage of your Social Security benefits that are going to be taxable, you can include that amount on your gross income on your tax return. Now let's go through an example of this. I wanted to make this pretty realistic. Let's say you have $100,000 of adjusted gross income, and your Social Security benefits for you and your spouse are going to be roughly $60,000. Now, you're probably thinking that's $160,000 of income. Well, it's not really the case because we need to take into consideration your adjusted gross income only looks at 50% of your Social Security benefits. So let's go through this calculation step by step so we're on the same page with one another. And this is very true for a lot of our clients who want $100,000 or more of income in retirement, not including their Social Security. So here's a real life example. Your AGI, $100,000. Let's say, for simplicity, you don't have any non-taxable interest from municipal bonds. But your annual Social Security benefits are $60,000. So your combined AGI plus your non-taxable interest plus half of your Social Security benefits is going to come out to $130,000, not $160,000, but $130,000 for your adjusted gross income. This number is really the most important one to understand from an AGI standpoint, and your accountant can help you with this, or your financial advisor. Because now, with your $130,000 of AGI, this is your combined income. This is the number for the year. And this is the number that's going to help determine what amount is taxable. So we're over some of these thresholds, so let's go into detail a little bit more. Since your benefits are $130,000 from an income standpoint, you're well above the threshold for single filers, which is only $25,000, and for married filing jointly, which is $32,000. So a significant portion of your Social Security benefits, it's going to be taxable. But there are two thresholds to consider. These are very important. And I'm going to save them for the next break because I want to make sure that we have a really great understanding for these thresholds. This is why you're going to want to stick with us for the next segment. We're going to get into the details from a tax perspective and what your tax bill could potentially look like, not including the state that you live in, because that's different as well. But today's episode is all about taxes in retirement, and your Social Security, unfortunately, as we said earlier, could be taxed up to 85%. So stick with us. We're going to have some ideas on how to help you through this throughout the show. Thank you for watching the Retire As You Desire show. So let's take things even deeper right now. Let's calculate what the taxable amount is going to look like for you, depending on your federal tax return. So 85% of your Social Security benefits is going to look like 0.85 multiplied by your $60,000 of Social Security benefits. 85% of $60,000. That means that your taxable amount is going to look like $51,000. You don't need to be afraid going into a next tax bracket. I think that's a big misnomer for retirement income planning. I hear this a lot. I've heard this with new clients coming on board. Our accountant said, don't go into a new tax bracket. Our old advisor said, don't do this or don't do that. We need to understand that if you go into a new tax bracket, it's not the end of the world. Municipal bonds, if you've been a high earner, which a lot of our clients are, this can still create taxation on your Social Security. Welcome back to the Retire As You Desire show. And in our last segment, I showed people how your Social Security is taxed. I showed you the thresholds, whether you're filing single, married, filing jointly, or if you're a head of household. All of these things are going to play a huge role in retirement. Now, in the last scenario, $130,000 of adjusted gross income. That's your AGI. Your accountant could potentially help you figure out all these numbers for your own scenario. We're just using simple numbers for easy comparisons in today's show. So I want to describe now what it looks like to have up to 50% of your benefits that are taxed. If combined income is between $25,000 and $34,000 for single filers, or $32,000 and $44,000 for a married filing jointly couple. Up to 85% of those Social Security benefits are taxable if combined income exceeds $34,000 or $44,000, depending if you're single filing or married filing jointly. But if your combined income, if you're married, which is $130,000, 85% of your Social Security benefits will be taxable. 85%. It's huge. So let's take things even deeper right now. Let's calculate what the taxable amount is going to look like for you, depending on your federal tax return. So 85% of your Social Security benefits is going to look like 0.85 multiplied by your $60,000 of Social Security benefits. 85% of $60,000. That means that your taxable amount is going to look like $51,000. You're probably thinking, what? I didn't know about this. That's why you're watching the Retire As You Desire show. But therefore, $51,000 of your Social Security benefits will be included in your taxable income. It's a huge amount, huge amount. So the final taxable income calculation is all about your taxable income is going to equal your AGI plus the taxable portion of your Social Security benefits is going to really create that taxable income. It's very important to know this. So going back to your AGI, which was $100,000, if you add $51,000 of the taxable portion of your Social Security, that relates to $151,000 now, because we're over these taxable thresholds of taxable income. So you're going to be taxed on $151,000, not the $130,000, unfortunately. So you're going to have a higher tax bill because of this. This is why it's so important to plan to try and avoid this before you go into retirement, and understand where your dollars are going, whether they're going to be taxed later in retirement or if you pay your tax bill up front. I prefer paying the tax bill up front, as you can see why. Now, here are some things that we really need to take into consideration as well. We work with clients in multiple different states throughout the United States, and some states have different taxes on your Social Security benefits, but the rules vary widely. You're going to want to check your state's tax guidelines to determine if your benefits are taxable in that state. And that's another thing to really understand is, where are you going to retire? If you want to retire in a tax-friendly state, it may cost you more money to buy a home. So there's a lot of different variances that are going to go into these big time decisions. Now, you're going to receive a form called SSA 1099. Each year you receive a benefit from the Social Security Administration, you're going to receive this SSA 1099. And this shows you the total benefits that you received during that calendar year. You're going to use this form to help determine the taxable portion of your benefits with the IRS and your accountant or your financial advisor. Now, the IRS does have worksheets to help provide some instructions. So if you're a do-it-yourselfer investor and you're here watching this show for great information, you could do a 1040 SR. That could help you calculate the taxation of your Social Security benefits for the future, for that year. Now, from a taxation standpoint, your benefits are going to depend on a lot of different scenarios. Where your money is coming from an income standpoint, how much you're receiving from a Social Security standpoint, and you have non-taxable income. All these things play a huge role for your retirement, and it's going to play a big role from a taxation standpoint. And being a financial advisor, it's really coming down to how much money are you keeping from your investable dollars. That's part of the game in retirement. Albert Einstein said, it's all about knowing how to play the game in the best way possible, and understanding the nuances of Social Security taxation is a big deal in retirement planning. So if you're thinking, how in the world am I supposed to receive income in retirement from my investments? Here are some tax saving strategies to help you along the way for your retirement years. Number one, this is something that we do with our clients pretty consistently, is analyze whether you should do what's called a Roth IRA conversion. Now, I want to be very clear. You want to know where you're at from a tax bracket standpoint. How close are you to jumping into a next tax bracket if you're going to do a Roth IRA conversion in retirement? But there is a caveat to this, a huge one. If you jump into a next tax bracket, let's say you go from the 22 to the 24% tax bracket, this is not going to make your whole entire dollar amount taxable at that higher tax bracket. Let's say you only go $1 over into the 24% tax bracket. That $1 is going to be taxed 24 cents on the dollar, just that $1. There's separate brackets, and once you hit different levels, whether it's at 10, 12, 22, 24, etc., tax bracket, the dollar amounts that you're inside of that bracket get taxed at that bracket. It's called a marginal appreciation. So you don't need to be afraid going into a next tax bracket. I think that's a big misnomer for retirement income planning. I hear this a lot. I've heard this with new clients coming on board. Our accountant said, don't go into a new tax bracket. Our old advisor said, don't do this or don't do that. we need to understand that if you go into a new tax bracket, it's not the end of the world, because if we're hitting those numbers anyways, your Social Security is probably, I'm saying probably, at an 85% taxation rate at those levels, especially if you're at the 24, 32, and those higher tax brackets. So from a planning perspective, we want to look at doing Roth IRA conversions and understanding what's the break-even point. How many years do I need to invest this money after I pay my tax bill to get to this break-even point? This is very important. We can calculate this for you, but also municipal bonds, if you've been a high earner, which a lot of our clients are, and if they're using them, this can still create taxation on your Social Security, even though it's going to basically be tax-free income for you, but it's included in the Social Security aspect from a correlation taxation standpoint. It's confusing. It's super confusing. This is why you want to work with a professional. Now, income from life insurance, if you've set up a life insurance policy that has tax appreciation, that has some cash value built inside of it, if you take money out, which may or may not be in your best interest, you have to work with your advisor on this, but this could help not make your Social Security taxable. So this is a tax strategy that some people have used, but again, you're buying life insurance for life insurance or estate planning standpoints. But this tool could be used to help mitigate some taxes in retirement if you want to borrow money against the cash value, but you have to look at the benefits. There's never a perfect scenario with this, but this could help try and mitigate some taxation in retirement. And the one thing that does not make your Social Security taxable is income from Roth IRAs or Roth 401ks. The reason for this, you've already paid your tax bill, and this is what I'm in favor of. This is what we help our clients with. Pay your tax bill now, so that way when you want to withdraw money in retirement, you could potentially keep more of your Social Security income. You could potentially not jump into a new tax bracket. You could potentially not make your Medicare premiums more expensive as well, because there's 4 different tax brackets from that standpoint as well, something we're going to discuss on another show, that makes your Social Security and your Medicare premiums taxable. So there's more money coming out of your pocket. At the end of the day, this money is yours, and it's really wise to plan to keep the money in your pocket, and that's what we are here to do at the Retire As You Desire Lifestyle Company. Just want to help you get your money in great places to help you have a great retirement and hopefully not pay as much taxes in retirement. Stay tuned. Gonna have a great wrap up for the segment here. Stay tuned to the Retire As You Desire show. So withdrawing from a Roth IRA account. Now, traditionally speaking, when you withdraw from a Roth IRA account, it's tax-free as long as you follow the rules, and there are certain rules, but this could help reduce your combined income. Another thing to do is manage other income sources. You want to be mindful of other income that may increase your AGI. Welcome back to the Retire As You Desire show. In this episode, we're talking all about the taxation of Social Security. And yes, I know it's surprising. Your Social Security could be taxed. Probably not happy about this. But I'm going to show you some ways to navigate these tax obligations on your Social Security income. But it can be very complex, and I want to make sure I'm very clear on this. You want to work with a tax professional or a financial advisor who could help you through these scenarios. You want to get a great team around you. And if you're an investor who loves to do it yourself, thank you for watching this show. Thank you so much. And I'm hoping to give you some great strategies that could help reduce or eliminate some of these taxes owed on these benefits that you've paid into for many years during your working years. So here are several approaches to consider. Not one's perfect, not one is better than the other. It just depends on your own financial situation. Number one, just understanding the different taxable thresholds is crucial. Understand how to play the game and play it to the best ability possible. Your Social Security benefits may be taxed based on the combination of income, which is the sum of your adjusted gross income, non-taxable interest, and half of your Social Security benefits. This is how the IRS looks at the taxation for your Social Security benefits. Again, I want to hit these thresholds for you so we're very clear on how this looks. So if your income is between $25,000 and $34,000 for a single filer, up to 50% of your benefits may be taxable. Anything above $34,000 may be taxable up to 85%. It's a big deal. If you're married filing jointly, if your combined income is between $32,000 and $44,000, up to 50% of your benefits may be taxable. When we go over $44,000, up to 85% may be taxable. So reducing your combined income can be a game changer in retirement. So if you lower your combined income, this could help you keep some more of your Social Security benefits and help keep you below these thresholds. Here are some great strategies that our clients use and other people that I know have used in the past. So withdrawing from a Roth IRA account. Now, traditionally speaking, when you withdraw from a Roth IRA account, it's tax-free as long as you follow the rules, and there are certain rules, but this could help reduce your combined income. Another thing to do is manage other income sources. You want to be mindful of other income that may increase your AGI, such as dividends, interest, capital gains. All of these things play a role in retirement. Here are some strategies like tax loss harvesting. This could help offset gains, and that's when you sell a losing stock versus a winning stock to help offset taxes. Now, considering municipal bonds. Interest from a municipal bond is typically tax-free and not included from an income standpoint, but it could affect your AGI. And then adjusting your investment strategy to reallocate your investments to minimize taxable income. This could be really beneficial, and there are some great tax managed funds out there that could be really utilized for these strategies. Now, focusing in on tax efficient investing could be a great source of income for you in retirement. In essence, we may want to generate less income from these strategies, but utilizing an index fund or a tax managed fund could be a home run for your income in retirement. So utilizing tax deferred accounts, meaning 401ks, IRAs, maybe a SEP IRA or a simple IRA, if you contribute to these on a pre-tax basis, this may be really detrimental because these are the types of withdrawals that make your Social Security potentially taxable. So you may want to readjust this to do tax-free investing, whether it's a Roth 401k, Roth IRA, which I love. This could help create tax-free income for you, and not to mention your beneficiaries. When they inherit the money, they could have a much more favorable tax benefit for them for their future as well. So that's something to consider for their future as well. Now, this is a strategy that I love. I really love this. This comes into consideration if you have your health, if you haven't had a stroke, heart attack, cancer, the list goes on, but understanding your health could be a big game changer in retirement. So let's say you delay your Social Security benefits till 70 and you start using your pre-tax money first. This could allow you to take out more money from your investments or do Roth IRA conversions and put these benefits into a much more favorable tax scenario for your future. This gives you more time to allow to withdraw from taxable accounts potentially, and it could potentially reduce taxable income later. It's the name of the game. And this is going to allow you to be very strategic with your withdrawals from a planning perspective. The timing and the sources of your retirement withdrawals must be planned out carefully, which is why you want to work with a professional. Now, let's say you withdraw from taxable accounts first. This could delay the taxation on your Social Security because it allows your Social Security to grow, and that grows tax-free. When you withdraw money from a Social Security standpoint, if you're not taking pre-tax withdrawals, if you don't need that, if you've paid off all of your debts, you might be able to live off of these Social Security benefits with these higher guaranteed amounts from the Social Security Administration. So you pay your taxes up front. You could stock up a piggy bank as well from your withdrawals and potentially do Roth IRA conversions. And this could give you tax-free accounts to manage your income levels very strategically in retirement. And another thing to do is to consider your filing status with the government. If your tax filing status can impact the taxation of your Social Security benefits, you want to be wise as to where you withdraw your money from and when you do it. So if your spouse and yourself, if you saved up in all pre-tax money, especially in 401ks, you may want to use those dollars first and delay your Social Security to 70. The thing is, this could be a big benefit for one of the spouses, but it can also result in a higher taxation if we don't do this due to the loss of other benefits. We want to consider the overall tax impacts very carefully. Here's a fun one: relocating to a tax-friendly state in retirement, and a lot of our clients have done this. These states do not tax your Social Security benefits: Florida, Texas, Nevada, and Washington. If you're considering moving out of a state that taxes your Social Security benefits, you want to stay informed because the government and the states are going to be looking for new tax benefits, and the tax laws could potentially change. So you want to stay updated on the latest tax regulations and really consult with a great tax professional to help you make the best decisions possible from a tax standpoint. And this is why working with a retirement income certified professional is pretty crucial as well. But if you work with a great team, this could potentially create ways for you to keep more of your money, pass down assets to your children if you're so grateful to have them and blessed to have them, to get to different phases in retirement. And just knowing in and of itself if your Social Security is going to be taxed is a game changer. And that's why it's been great to give you this wonderful information on today's show. So again, converting a traditional IRA to a Roth IRA, this could be a huge impact on the taxation of your Social Security benefits. It could be a big savings for you as well, especially from a required minimum distribution standpoint. So when you turn 73 in America, and if you have pre-tax dollars, the government is going to mandate that you take a withdrawal out of this account every single year. And those withdrawals go up. Go figure. You've been able to save for 30 or 40 years tax-free, but at some point you have to pay the piper. So the government is going to mandate you to take a withdrawal. And if you don't, the penalties are pretty substantial. You could have a 50% penalty if you don't take out your required minimum distributions. It's a big problem. It's going to be a big loss of your money as well. So if you delay your Social Security to 70, you're going to have a higher Social Security amount. But if you don't take your pre-tax distributions before your Social Security income and you delay that till 70 as well, it's just going to create a big tax bomb for you. It's really, they call this a tax torpedo in our industry because your money is hopefully still growing, tax-free. You have to start taking money out, your account values are higher, and your Social Security is higher. This is why doing Roth IRA conversions early on, even before retirement starts, could be a huge benefit for you in your future retirement years. So tune in to the next segment. We're going to talk about the break-even ages for your Social Security, and it's going to help you make better decisions for your planning. So stay tuned to the Retire As You Desire show. Let's go into this a little bit deeper with actual numbers. So the break-even age would be at the age in which the total cumulative benefits received from claiming early, $1,050 a month for 60 months, is equal to the total cumulative benefits received from claiming at a full retirement age, which was $1,500, which is going to equate to 48 months. See how there's a big difference there? It takes longer, a couple more years for you to break even to get your money back that you've essentially paid into this system. Welcome back to the Retire As You Desire show. In this segment, let's discuss the break-even points from an age standpoint for your Social Security. This is something that is pretty easy to be analyzed. There's great calculators. Your advisor could help you with this. But this is something we want to understand before you start receiving your Social Security income. So let's discuss the break-even ages for your Social Security income, because this could have catastrophic effects on your retirement income and also your spouse's, depending on your scenario. But knowing your break-even age is going to help you make better decisions, and it's really based on your health. If your health is great, you may want to consider delaying your Social Security, start to do some potential Roth IRA conversions. Again, it's not a blanket recommendation, but things to consider and look into, especially if you think taxes are going to go higher in the next 5 to 10 to 20 years. But the break-even age for Social Security benefits is going to refer to the age at which the total benefits that you receive under a different claiming strategy becomes relevant. You get to understand, if I do it at 62 versus 67 versus 70, what age am I going to break even? And claiming strategies are so important here. Let's go through an example. Let's say you delay your claiming benefits 1 year later. So instead of 65, you do it at 66. You're going to receive a higher monthly benefit. That's great, more money in your pocket. But you receive them for fewer years compared to if you would have claimed them a year earlier. See how there's a difference there? So if you receive them for more years, but at a lower monthly rate, which one makes more sense? This is something that we help our clients with all the time. So factors that are going to influence different break-even ages are the following. Your claiming age. A lot of people think the Social Security Administration is broke. I need to take my income at 62. I think it's going to run out of money. And I think that's a poor mindset, because it could really affect your Social Security benefits for the future, especially if you live longer, and it affects your break-even age. So let's say if you do live longer to 95, don't you think your life expectancy is going to play a crucial role? Wouldn't you want to have a larger income and live longer rather than just starting them earlier? Those are things we want to consider, but really understand your benefits over your lifetime. Now let's talk about investment returns. Some people start their Social Security and they invest that money right away because they think they could get a better rate of return on that money. Some people wish they never paid into Social Security because they think that they could have made more money than the government did. It's a personal thought, but I've heard it a lot over the years. So for those with an average life expectancy, the break-even age tends to be around the mid-70s. Depends if you're a male or female versus married and single. It all changes, so there's not a one-case scenario that fits all. But delaying your benefits beyond your full retirement age is typically going to result in a higher break-even age. So we're looking at closer to, your mid-80s for those break-even ages to happen. Now, if we're going to get a little bit more specific, for men and women, break-even ages are typically similar for men and women because Social Security benefits are calculated based on the same formula. So it's not male versus female, but life expectancy is the most important part. And these life expectancy tables are generally similar, but women do tend to live longer than men. But individual factors like your personal health and your family history, obviously they're going to have a big influence on this. But there's an interesting stat on married couples. Break-even ages can vary drastically between spouses due to different ages and claiming strategies and benefit amounts, and also life expectancies due to your health. Coordinating your benefits and claiming overall strategies can optimize overall benefits for the couple. And then the survivor benefits. This is one of the things that we want to take into consideration, and I'm going to give you a real-life story right now. One of my clients, he unfortunately just passed away of cancer, but he delayed his Social Security benefits to age 70. And he did this on purpose because he was the only one who worked in his household. His wife raised their 2 kids. They had a great life, but unfortunately, he passed early. But this strategy is helping out their family now. Unfortunately, he's not with us anymore. But his wife has a much higher benefit and has taken over his Social Security benefits because she was the surviving spouse. And a survivor spouse, they get the benefit of their partner's Social Security income or theirs, whichever one is higher. They don't get both, but by delaying your benefits, this could lead to a higher benefit for your spouse after you're not with us. But this allows my one client to still live in a comfortable way even though her spouse is not with us anymore. So let's go into this a little bit deeper with actual numbers. So let's say an individual is eligible for a monthly benefit of $1,500 a month at their full retirement age of 67. Let's say they claim benefits at age 62. Their monthly benefit is going to be reduced to roughly $1,050. So they're missing out on $450 a month. So the break-even age would be at the age in which the total cumulative benefits received from claiming early, $1,050 a month for 60 months, is equal to the total cumulative benefits received from claiming at a full retirement age, which was $1,500, which is going to equate to 48 months. See how there's a big difference there? It takes longer, a couple more years for you to break even to get your money back that you've essentially paid into the system. From a consultation standpoint, just because Social Security is super complex, it doesn't mean that you don't have to go into this scenario without knowing your own numbers. Have a consultation with someone who really specializes in this area and work with a financial advisor to help you with this. Use the calculators on the IRS website. Reach out to the IRS. But please don't go into retirement without knowing all of your numbers, your break-even points, the taxation on your Social Security. Do Roth IRA conversions make sense? What's the actual break-even age because of my spouse? What should we do together? And how do we start taking income from our Social Security benefits throughout retirement? The thing is, there's no beneficiary after you and your spouse pass away. So these assets cannot pass down to your kids or grandkids. So this really creates a complex scenario to use your pre-tax dollars first versus your Social Security. It's a cart before the horse scenario. But knowing your taxation on all of your dollars, I think, is the most critical point in today's environment. So don't forget to get your money right, do your planning, take the time, don't make hurried decisions, but also know how your health plays into this whole scenario. You and your spouse are hopefully going to have a lot less stress by making better financial decisions together and knowing your numbers. Knowing the numbers tells a story. It allows you to make better decisions. But at the end of the day, less stress is going to lead to a better retirement. Tune in every Friday night for great information just like today's show, 6 p.m. Central Time, and we're here to help you retire as you desire. Hey everybody, Bill Bloom here. We've been getting a ton of amazing feedback about the Retire As You Desire TV show. We used to have the podcast. The TV show is now being part of our podcast. So the story behind this and how it came to fruition is I went down to Houston to be on an incredible entrepreneur's 2 television shows. And while I was down at the studio, the producers were asking me, you know what? I like you on camera. Would you like to have your own TV show? So I said yes, of course. I would love to provide value. And this was a way for our clients and our viewers to really get in touch with what we're doing at Bloom Financial, how people can actually retire as you desire, and what it actually means. And the whole entire TV show is about giving people value, showing people how they can actually retire with confidence. And I want to show people the steps on how to retire as you desire in the simplest way possible. Every Friday night at 6 p.m., we're going to have a new television show filled with great guests, great information about investing and retirement and tax planning. You could find our show available on Now Media TV and the Epic Fit Network every single Friday night at 6 p.m. Central.